Good afternoon, everyone, and welcome to the McGuire-Woods Hot Topics and Best Practices for North Carolina Continuing Care Retirement Communities. My name is Lisa Williams, and joining me are my colleagues Brian Barger, Bill Gray, and Lauren Ramos. Thanks to everyone for tuning in today. Before we get underway, let me mention a few housekeeping items. On your screen, you will see several widgets toward the bottom. Let me call your attention to a couple in particular. First, the green meeting materials widget includes a copy of the presentation. A link to those materials will also be sent via separate email. Second, you will see a purple Q&A feature. Please use this to submit any questions that you have throughout the webinar. At the end of the program, we will do our best with any time remaining to answer any questions that we have. Otherwise, if we do not have any time, we will follow up with you individually after the program. Please also note that this presentation is being recorded. We will circulate a link to the recording together with a webinar deck and an evaluation form after the presentation has ended. We greatly appreciate it if you could complete the evaluation, as it helps us improve our offerings and gauge interest in future topics. That's it for our housekeeping instructions. Today we will be covering corporate governance and tax matters, matters in taxes and financing, matters in labor and employment, and healthcare, federal law, and contracting considerations. Now for our first topic, I will push it over to Bill Gray.
Thanks, Lisa. Good afternoon, everybody. In the corporate governance and tax matters topic, we're going to be looking primarily at what's been making the headlines for the last year and a half, the effects of the Tax Cuts and Jobs Act on both 501c3s like continuing care retirement communities and on the donors and contributors who support them. We're also going to be then taking a brief look at a couple of other topics dealing with endowments and also forming new affiliates. The first thing that the Tax Cuts and Jobs Act did, it generated a lot of publicity in the press, was to lower the corporate tax rate, which may sound irrelevant to tax-exempt organizations, but to those who have business activities that generate unrelated trade or business, and therefore taxable income, the change in tax rates is important. The rate dropped from 35% and down to 21%, a flat rate. And a reduction of the corporate tax rate would seem like a good thing. Note, though, that it is only a good thing for organizations that had unrelated business taxable income of over $90,000 a year, because otherwise, going to a flat rate and eliminating the lower rates that led up to 21% even, causes tax-exempt organizations to pay more tax on their unrelated business income than they would otherwise have paid. So very much the effect depends on the amount of unrelated business taxable income that a particular CCRC may have. Now, if you have more than one unrelated trade or business, then the siloing rules of the new Tax Act become important. Up until last year, when the new rules went into effect, it was possible for a CCRC with multiple trade or business activities to net out income from one against losses from the other and to pay tax only on that net amount. For years beginning after 2017, excuse me, that's not going to be possible. Each unrelated trade or business is judged on its own. Its income is calculated and taxed on its own. That leads to questions now need to be answered that never were relevant before. That is, what is a trade or business? What constitutes a separate trade or business? How are expenses to be allocated among trades or businesses? And what do you do with things that are treated for tax purposes as separate trades or businesses but really aren't? For example, income from an investment partnership that in turn invests in multiple businesses, or income that's just treated as unrelated trade or business because the tax law says so, even though it doesn't involve any actual business. Those are all going to be important questions to answer in the near future, and we're hoping for guidance from the IRS on those. Another thing that is clear as a result of the siloing rules is that net operating losses can no longer be used the way they were. First of all, the primary rule, losses from one activity can't offset income from another activity. Also, the losses can no longer be carried back and only be carried forward and used to offset income from the same trade or business that generated the losses. And note that even in that instance, a loss can't completely offset unrelated business income for the year. It can't offset more than 80%. Now, in addition to the net operating loss rules, Congress also changed the rules relating to certain fringe benefits and caused tax-exempt employers to owe an excise tax on amounts that they pay to provide certain qualified benefits for their employees. This primarily affects organizations that provide free or reduced cost parking for their employees. And note that what is taxable is not the value of the parking to the employees, but rather the amounts that the employer paid or incurred in order to provide the parking. So this is going to require a lot of analysis by exempt organizations to figure out what costs are associated with the parking they're providing to their employees, how to allocate those costs fairly between employee parking and, for example, public parking. Also remember that even if there is a cost involved there is a $1,000 exemption from unrelated business income tax. So if the cost to the employer is not more than $1,000, there's still going to be no tax. But otherwise, employers that have never had to file an unrelated business income tax return before may have to file one because of this new rule. Another item that has generated a lot of press is the new tax on certain types of what the code calls excess employee compensation. There are two branches to this, two types of compensation that will be taxed at a 21% rate. The first is remuneration in any year in excess of $1 million. The initial reaction there is, well, we don't have to worry about that because we're not paying anybody over $1 million. That may be true, but the same principles that apply here apply to excess parachute payments, that is, certain types of severance payments that are paid to employees who may earn less than $1 million. In fact, probably for most organizations, about the only effect of the $1 million tax is going to be to provide some cocktail party conversation. For example, if Duke and UNC paid their men's basketball coaches the same amount under these rules because of the quirk in the drafting, it would cost Duke 21% more to pay Coach K than it would cost UNC to pay Coach Williams. Other than that, there may be no practical effect on your particular organization from the $1 million compensation exemption. But let's look at how it works in the severance area. First of all, who is covered? A covered employee is any of the 5 highest compensated employees of the entity for the current year, or anybody who was in that group for any preceding year starting in 2007. It's sort of a Hotel California rule. Once you're in the group, you're never out again, which means that the organizations have to keep track of an ever-growing group of employees to determine whether they're hitting any of these compensation limits. Now, note that this includes not just compensation from the primary employer, but any compensation supplements, for example, from related foundations or other closely related organizations. So the tax liability can be generated by compensation from several organizations, and the tax liability is then allocated proportionately among those organizations, except to the extent that they among themselves may agree otherwise. Now, for the parachute payments, it's important to realize that that covers nearly anything that is paid to the employee due to separation from employment. You'll see on the slide there are some exceptions. But in general, you establish a base amount, which is the average amount of compensation the employee has received during the preceding 5 years. You compare that to the amount of the parachute payment for separation from service. And if the total parachute payment is more than 3 times the base amount, there is a tax triggered, the 21% excise tax. The tax, however, is not just on the excess over 3%, but rather on anything over the actual base amount, so 1 times rather than 3 times. This is imposed, again, regardless of how much the employee earns. It doesn't have to be Coach K or Coach Williams. It must be somebody who is in the covered employee group, so that the 5 or more highest compensated, and has to be highest compensated under a different code standard that doesn't require $1 million. Note also that there is no grandfathering here. This applies to existing contracts. Now, switching over from the direct effects on the charities to effects on their donors, you'll recall that there were a number of provisions in the Tax Act that reduced the tax burdens. Estate and gift tax exemptions were doubled, the income tax brackets were compressed, standard deduction was doubled, some of the other restrictions were removed. So we have this approach, we think, for the next 7 years. But note that while there were those helpful provisions, there also were a number of provisions that reduced tax breaks that individuals have been relying on for years. Personal exemptions are no more. State and local tax deductions are considerably lower. Home mortgage interest, less home mortgage interest is deductible, and no home equity line interest is deductible, and so on. So what is likely to be the net effect of all of this? The larger transfer tax exemptions might indicate that people would have more incentive to give to charity because they wouldn't have to pay as much to the government. At the same time, it may provide less incentive to charity because they no longer need the charitable deduction for their for estate tax avoidance. Likewise, on the income tax side, it remains to be seen. The projections from last year said that maybe no more than 5 to 10% of all taxpayers would be able to itemize deductions and therefore get a benefit from the charitable contribution deduction. Now, where does this leave CCRCs and other charities? I think it leaves us with the need to get out a couple of important messages. The first one is simply, we're still there. We're still doing the same great work that we've always been doing, and in fact, the needs are growing. The second is that the planned giving vehicles that have worked so well in prior years continue to work well under this new tax regime, so that gifts that will allow you to avoid capital gain tax or to postpone gain, to receive some part of tax-free income, things like that will continue to work well, and donors need to be aware of that. The time to communicate with them is now, because many are still feeling the sting from April 15th with a tax bill that was higher than they thought there might be. Note also, though, that we can't depend on year-end any longer to remind many donors of these types of charitable issues, because December 31st is no longer a deadline for people who don't itemize, and that could be 90% or more of the population. At the same time that we're trying to acquaint people with these rules and with the continuing need, we also need to be aware that we're going to be encountering some new techniques and some new ways, perhaps, to support charities. Things like program-related investing, impact investing, using 501c4 social organizations that don't generate income tax deductions but do generate gift tax deductions, using low-interest loans, or using bunching of gifts, making gifts you would normally make in several years to something like a donor-advised fund or a private foundation that can then dole them out to the intended charities over a number of years. So all of that, it's a new world out there in terms of the ways that donors may react, and it's going to take us a while to determine exactly what the effects are, what donor concerns may be, and how they may choose to support our organizations. Now I want to switch for a couple of minutes just to talk about endowments and other restricted funds. We have in North Carolina, and in fact in every other state in the Union except one, the Uniform Prudent Management of Institutional Funds Act. That statute sort of turns the traditional concept of an endowment on its head, because it says that endowment spending is no longer restricted to income or even to income and capital growth. Rather, if the board of a CCRC determines that it is prudent, it can spend as much of the endowment fund as it thinks appropriate in a particular situation. And there are 7 specific factors listed in the statute that a board is to consider in order to determine whether it's appropriate to spend from an endowment, whether the spending comes from income, capital growth, or the original principal value. But what happens if you have an endowment with a restriction that, for whatever reason, has become unworkable? For example, requirement to invest only in railroad stocks, or an endowment that can be used only to find a cure for some disease that already has been cured. Well, in that case, there are several ways that you can modify an endowment or other restricted fund to meet current circumstances. One is, of course, with the donor's written consent, and another is if there is a power of modification in the gift instrument. But if neither of those is present, you can modify the procedure for investing and managing an endowment if you show the circuit court that the existing restrictions have become impracticable or wasteful, or they impair management or investment, or that they were the result of, or that circumstances have changed in a way that the parties didn't anticipate. And if you need to have a whole new purpose for an endowment, for example, you can also get court approval for that if you can show that the original purpose has become unlawful, impracticable, impossible to achieve, or wasteful. And note that there is a shortcut procedure that doesn't require you to go to court, but simply to notify the Attorney General if the fund is less than $100,000 and more than 10 years old. So those are a couple of things to keep in mind just in terms of trying to modify endowments or other restricted funds. And finally, just a word on forming affiliated entities. One of the possibilities that came out of the earlier concerns about the new trader business rules and not being able to net losses from one against income from another was to drop them all into a single taxable subsidiary that then could net those amounts. There may be, however, a number of other non-tax related reasons to form an affiliated entity, whether it's separate management, whether it is liability protection. You'll see a number of them listed there. The point that I want to make on this topic is simply that there may be a new alternative. Traditionally, organizations like that have been formed as non-stock corporations, and that still is a viable alternative. If you're trying to form a tax-exempt entity, though, a non-stock corporation has to go through the same exemption application process with the IRS that your CCRC went through in the beginning. That involves a little bit of cost, but it also means that you are in an administrative limbo for a period of several months while the IRS is processing the application and trying to confirm that your new affiliate qualifies for tax-exempt status. If the new affiliate instead is a single-member limited liability company with your CCRC or one of its 501c3 affiliates as the single member, then it has two advantages when it comes to its tax-exempt status. First of all, it qualifies immediately as a 501c3 by virtue of its affiliation with your CCRC without having to go through the exemption application process. Second, it doesn't have to file separate Forms 990 information returns, but instead, all of its income and expenditures are shown on the 990 of your CCRC. So there is no increase in the number of returns that have to be filed either. So for both of those reasons, in appropriate situations, a single-member limited liability company may be a good way to form a tax-exempt affiliate in order to meet some other need. So with that very quick run through the tax and corporate matters, I'll then turn it back to Lisa Williams to talk about tax-exempt financing.
Thank you, Bill. So today we're going to talk about two topics that have been hot in the tax-exempt financing world. One is the 2019 amendments to Rule 15c2-12, and the second is the replacing of the LIBOR index. With respect to, I also wanted to just note that I am a partner in the firm's public finance department. A large portion of my practice is with respect to tax-exempt financings as well as interim financings for retirement communities. Both with, I've done new construction as well as renovation and expansions, and also with respect to restructurings of existing debt. So with that, we will look to Rule 15c2-12. The SEC requires that broker-dealers obtain an agreement, sometimes known as an undertaking or continuing disclosure agreement, from one or more obligated persons with respect to a tax-exempt financing that is done on the public market. The broker-dealer is required to, in this undertaking, to get annual financial and operational information from the obligated person, as well as certain event filings. And over the past 10 years, the SEC has made a number of amendments to Rule 15c2-12 with the intention of making the market more transparent with respect to information, as well as protecting investors. In 2012, the SEC put out a report that indicated a number of areas of interest and focus that the SEC had, and included in this report were amendments to Rule 15c2-12. Earlier this year, the latest amendment became effective as of February 27, and for years, the SEC has been encouraging issuers and obligated persons to provide voluntary disclosure with respect to direct purchase and direct placement transactions. Since the 2008-2009 recession, the SEC recognized that many borrowers, and in particular retirement communities, in my experience, this has been a useful tool, has been using direct purchase transactions in lieu of going to the public market. One, it was financially beneficial, as well as covenants, and working with banks has been beneficial from a covenant perspective. Although the SEC made a number of pronouncements asking for voluntary disclosure, the SEC found that there was very little by way of voluntary disclosure on Emma, which is the database for which filings are made. So earlier this year, 2 new events were added to the list of 14 event disclosures that were mandated by Rule 15c2-12, bringing the total events up to 16 events. The first event, what's known as Event 15, with respect to the incurrence of a financial obligation. And then the second event, Event 16, is with respect to events that occur that reflect financial difficulties of the issuer or obligated person. Now, with respect to these events, there are a materiality component to these events. It's specifically Event 15. As the SEC has done with respect to other guidance, they continue to refuse to define exactly what is considered material, and have stated that material is really a facts and circumstances test based on the issuer or obligated person. So if you're a large system, or if you're a standalone CCRC, what you deem as material is going to differ. Like the other events within Rule 15c2-12, an obligated person is required to disclose the occurrence of an event within 10 business days, and that did not change with the new event filings. Also to note is that the form of these event notices, specifically with Event 15, was not prescribed by the SEC, and they just noted that material terms needed to be disclosed with respect to Emma. So first, what is a financial obligation? The amendments defined it as a debt obligation, a derivative instrument, or guarantee. Through the comment period, there were a number of other definitions that were included, a number of items that were taken into consideration with respect to a financial obligation. However, they were removed, and it was limited down to these 3 items, as the SEC found that this was going to be broad enough. Now, excluded from the term financial obligation is a municipal security as to which a final official statement has already been provided to the Municipal Securities Rulemaking Board, with the thought that these obligations were already out for public disclosure and are already available on Emma, so there was no need for any additional transparency. Now, a couple of things to take away from these new amendments. First, any continuing disclosure undertaking that was in effect prior to the effective date is unaffected. So events 15 and 16 do not get grandfathered into any undertaking that was already in place. The amendments do apply to any primary offerings after the effective date. So if you have a public offering that happened in March of 2019, unless you had an exemption from Rule 15c2-12, your undertaking needed to include events 15 and 16. And therefore, investors with respect to those municipal securities would get the benefit of the new amendments with respect to Event 15 and 16. Now, another thing to take into consideration is that the definition of financial obligation does treat different obligations separately. So if you have a municipal security that then gets layered on a guarantee, that guarantee is a separate obligation from the municipal security itself. Similarly, if you have a derivative, some sort of swap with respect to the municipal security, there's going to be a separate obligation, disclosure obligation with respect to the derivative as compared to municipal security. So if you enter into a public offering that has a final official statement that is disclosed on EMMA, that has an exemption already from the exempt Event 15. However, the derivative that may be associated with that financial obligation does not have an exemption because it does not get issued pursuant to a final official statement, and so it would have a disclosure obligation. And the key with respect to how they've defined financial obligation is that they want to make sure that they are looking at transactions that are likely to affect the liquidity, the overall creditworthiness, and maybe the existing security holders' rights. So they're looking for obligations that are going to have covenants that may affect these items, events of defaults, remedies. What they're not looking for are sort of everyday operating liabilities, copy machines, computers for your staff. Those are the types of things that are really, they're not looking for disclosure. So when they define financial obligation, it is their intention that these types of items were in fact excluded. They did not, in the original release, they were looking at leases as well. And with respect to leases, they opted to exclude it as a separate item, and as understanding that the GATSB rules were changing, and only those leases that are like debt were to be included in little I as far as a financial obligation. Now, with respect to Event 16, Event 16 is an event that that does apply to all of the debt that is outstanding for an obligated person. Now, again, it only applies to investors with respect to municipal securities that were issued after the effective date. However, with respect to Event 16, it does look at the obligated persons or borrower's existing debt as well. So if you have a bond issue that was issued in 2008, it starts, there is an event of default with respect to that particular issuance that is then deemed to indicate some sort of financial difficulty, while the holders of that particular debt don't have an undertaking that includes Event 16. The new holders of what you issued in March do have this Event 16, and this includes the disclosure with respect to that earlier obligation. So there is some confusion with respect to Event 15 and the timing of Event 16, because Event 16 does look at the borrower's overall debt portfolio, as it is looking to tell investors of the current financial condition of the borrower. So it's important to make sure that you understand the distinction of the effective date. Now, as we move forward in this new regime, underwriters that are going to be conducting diligence with respect to past compliance. Now, with respect to Events 15 and 16, that due diligence, we won't see that quite occur until you have taken an undertaking that includes these Events 15 and 16. So if you haven't done a deal since 2006, and then the broker-dealer won't have any disclosure responsibilities with respect to event 15 and 16. However, after you do a new transaction, say March of 2019, you come back to the market in 2 years. At that time, the broker-dealer is going to look at your undertaking from March of 2019, and they're going to look at events 15 and 16 and have to conduct the necessary due diligence to see whether over that time period, whether there was compliance with respect to any disclosures required by events 15 and 16. Now, what underwriters are doing at this time is they're seeing how obligated persons or borrowers have updated their continuing disclosure policies. We've seen over the past couple of years, ever since the what is known as MCDC, the initiative to look at past compliance with respect to continuing disclosure, underwriters have taken on a much more due diligence process with respect to past compliance. And so part of that has been asking the question, do you have a continuing disclosure policy? And we're seeing more and more borrowers put these in place. It's a way to keep checks and balances to make sure that this is happening at your institution. It's also a good reminder when you have staff changes. And so if you don't have one in place, it's something that management should consider. And if you need assistance with that, happy to answer any questions with respect to what those policies should look like. Again, it's a facts and circumstances test as far as what those policies should look like. There's not a one size fits all. We understand that, and as well as underwriters, that there are institutions that have staff that are much larger than other institutions, and your policies should reflect your profile. The impact and manner of this additional diligence will not truly be seen until you've been subjected to these new events. But it is important to make sure you keep this in mind as you enter into new continuing disclosure agreements. As mentioned earlier, leases are not included in the definitive financial obligation except when they are treated like debt. So if you're using it as a mechanism to purchase property, then this would be an event that should be disclosed under Event 15. But again, if it's financing equipment of any sort, it is not to be taken into consideration. And to the extent that there are questions, reach out to your bond counsel or your borrower's counsel to look to see whether these anything that you are undertaking should be disclosed. So with respect to Event 15, with respect to any material financial obligation being disclosed, again, what is material by way of the terms of the new financial obligation is up to the beholder. So the Commission has indicated that at least the date of incurrence, the principal amount, the maturity and amortization, the interest rate should be disclosed. Now, what we are seeing is that, people are unsure of exactly how much further they need to go by way of disclosing material terms. And to keep in mind what is material, there's two questions that should be taken into consideration. One, would a reasonable investor view the information as altering the total mix of information when they're looking at all of the disclosure? Two, would the information be important to the investor's decision in investing in the municipal security? So the SEC, as we noted, did not prescribe the manner in which material terms had to be disclosed. So we're seeing a little bit of differences between borrowers on what they are deciding to disclose on EMMA. In the release, the SEC did note that it could be in the form of a summary, could be in the form of a term sheet, or could be in the form of the documents themselves. So many financial institutions in a direct purchase transaction will do what's commonly known as a continuing covenant agreement, and we're seeing those being posted on Emma. Now, an important thing to note, as with all disclosures that are posted on Emma, any Emma disclosure is subject to federal securities and anti-fraud laws, specifically 10b-5. So it is important to make sure that it's not misleading. It includes all material information, which is why many are really looking to post the entire document related to the direct purchase transaction versus having to make determinations with respect to materiality. Now, in deciding to post an entire document, there's a couple of things to take into consideration. One, there are a number of financial institutions that are requiring that if you are to post their document that they have with you on Emma, they would like to receive notice prior to you doing so. Second, some banks will want to have a say in what redactions are done with respect to the document before it is posted on Emma. And with respect to redactions, generally, many are looking to the MSRB guidance with respect to redactions that relate to liquidity documents, which allow for the redaction and removal of confidential information, such as names, signatures, account numbers. While not directly on point, it is analogous to the redactions that are permitted with respect to the continuing disclosure agreement. Now, with respect to derivatives, swap transactions, again, these are always going to be subject to disclosure and are treated separately from the municipal security for which they are related. Another thing to keep in mind, if you are doing a public issue transaction as well as a bank placement at the same time, which is commonly done in the retirement community financings, it is important to note that the bank placement is not going to be offered pursuant to a final official statement. And so although that the two transactions are happening simultaneously, the bank placement will need a separate disclosure pursuant to Event 15. Because even though it is done simultaneously with the undertaking that will include Event 15, and it is likely that your final official statement with respect to the public offering will reference the new bank transaction, it will still technically fall within the rule and require an event filing with respect to that bank placement. Just a few notes on the replacement of LIBOR. LIBOR is the London Interbank Offered Rate. It's been the benchmark that has been used for many years, and it's based on submissions from the panel of banks of estimating the daily rate for each bank to borrow money from another bank. And it's posted on a daily basis. Now, as many people know, LIBOR is in the process of being phased out and is expected to be phased out by the end of 2021. Now, what is going to be the impact of this? Well, there are trillions of dollars that have their rate tied to the LIBOR index. So it is something that every financial institution is acutely aware of and is trying to determine how to move forward. And the reason for this phase out is due to in part the financial crisis and some rigging scandals that were resulted in determining that several banks were found to be manipulating the rates to their advantage. During that process, there were a number of fines that financial institutions had to pay as a result of those rigging scandals. So the big question that everybody has is what will replace LIBOR? Unfortunately, nothing has been officially set. Now, the ARC committee has identified SOFR, the Secured Overnight Financing Rate, as the U.S. sort of rate that we think we will be going to. Again, it is not for sure. It's just they've started calculating it and setting this index. However, it'll be an industry practice to see whether the industry will actually accept this as the replacement rate with respect to LIBOR. Something to note is that other countries have their own proposals on the table with respect to what they will use to replace LIBOR. Switzerland has an overnight rate that's based on repo rates administered by the Swiss exchange. Japan has a Tokyo overnight average. The European Central Bank has theirs. So to say the least, there's going to be a number of proposals out there by different countries that are currently all using LIBOR. The effect of this is that if there's going to be multiple rates, it could create a lot of inconsistencies and additional complexities. But again, there's no telling of how this will all play out until LIBOR officially is phased out in the next year and a half. SOFR, an interesting component to SOFR is that it's going to be an overnight rate versus LIBOR, which is currently a periodic rate based on 1 month, 3 month, or 6 month. So the industry is still trying to determine whether this is going to be a rate that is going to be indicative of a true borrowing rate. So with all this being said and all of the uncertainty, what is a borrower to do? One is obviously keep mindful of what exposure your particular institution has with respect to LIBOR. Most institutions will have either a bank placement transaction. Some still have a variable rate demand bond that's out there that is based off the LIBOR index. Also, if you have a swap that is currently outstanding, then it's important for you to know when LIBOR officially goes away and to know what your financial institution is doing with respect to the replacement of LIBOR. Now, what is the implication? The implication is that a modification may result in a reissuance of tax-exempt debt. A modification of a financial instrument is basically treated as an exchange. So once the rate is modified, if it's not done pursuant to the exact terms of the instrument, it can be deemed a modification and a reissuance. Therefore, if not done pursuant to the reissuance rules of the tax regs, then the tax-exempt bond could go taxable. Now, John Cross with Treasury has commented publicly that the IRS is going to need to get ahead of this in order to not have a complete meltdown of the tax-exempt market. Otherwise, the IRS is going to be inundated with tax-exempt bonds that are being deemed to be reissued. Personally, the IRS is not going to have the staff to deal with that many reissuance at one time. So it's going to be important to know what your financial institution is doing and to keep track of what guidance the IRS has come out with, because they are going to come out with something. It's likely going to be tied to SOFR. But talking to your bond counsel, making sure you stay ahead of what debt you have that is outstanding and how it's going to be impacted is going to be really critical to get out ahead of this. Now I'm going to push it over to my colleague, Brian Barger.
Thank you, Lisa. Good afternoon, everybody. My name is Brian Barger. I'm a partner in the Labor and Employment Group here in the Charlotte office. I've been a management, labor, and employment lawyer for over 28 years. But really, if you think about what I do primarily for a living, really I'm a triage lawyer. People typically call me when things are bleeding. They have investigations. They have internal issues where they need to terminate an employee. They have a government auditor at their door, and they need immediate action. I do a good bit of that. And then the rest of my time we spend up sort of patching issues, trying to prevent legal injuries, frankly, from occurring in the first place. And that's what we're going to do today. We're going to talk about three main things on the prevention side of the house. that are frankly just keeping us up at night, especially when you're thinking about CCRCs. First, the Me Too movement and increased claims regarding sexual harassment. Secondly, sort of independent contractor issues, and the Department of Labor's increasing focus on that versus employee status. And frankly, speaking of the Department of Labor, the new overtime regulations that have been resurrected yet again with respect to how and when individuals are deemed to be exempt from overtime when you look at the salary that is part of that test. So, with that in mind, let's start with the Me Too movement. And this has certainly garnered a lot of press, and certainly if anybody pays any attention, it started, frankly, with Harvey Weinstein and a good bit of sort of Hollywood sort of focus on this issue. But obviously, that was just the kickstart of something that's been perking for a long time. From a social media perspective, it frankly gained traction in that industry. But then it frankly spread to other industries as well, including healthcare, Of note, from a social media standpoint, the Time's Up organization, which really did focus a good bit initially on Hollywood, even has a brand new timesuphealthcare.org website focused specifically on sort of healthcare sort of outing, for lack of a better word, with respect to Me Too. And so it's spread to a variety of different areas. It's also spread to nonprofits outside of healthcare, so it's gaining traction. Despite that traction, I will say, and caveat for you, that there's no change in the law. You might think with all the publicity, with all the attention, that it would garner sort of potential congressional interest, or that there has been some sort of regulatory change which has sort of resulted in this sort of extra focus, but that's just simply not the case. The law regarding non-discrimination, sexual harassment, in general has stayed the same and has not really changed before or after the Me Too movement. The law regarding non-retaliation for reporting concerns internally and raising them internally or externally with the EEOC or others has not changed. And interestingly enough, the statute of limitation has not changed. You might think that with claims that are out there being resurrected some 10, 15, 20 years old, that implicit in that is there's some sort of change to the statute of limitation that has ginned this up. But that's simply not the case. The statute of limitation for most federal claims remains about 180 days or 360 days, depending on where you are, to file an action based on a concern with the EEOC. And for most state court actions, the statute of limitation has remained the same, at basically 3 years. Which changed, frankly, is just the social media attention. And you see this in the claims, even though a lot of people like to talk about sort of claims action in this area, when it actually comes to people actually filing things that stick. Interestingly enough, there was no uptick in EEOC claims after the Me Too movement. In fact, between 2016 and 2017 fiscal year for the government, the claims went down. And then they went back up again in 2018, which the EEOC liked to trumpet as a 12% increase. Of course, that was a 12% increase from the decrease, which they conveniently forgot to tell everybody. And so what we're really seeing, frankly, is things sort of rocking and rolling at about the same pace. The only difference is, frankly, strategy. People who don't have claims that are viable anymore, who don't have claims that have been brought within the statute of limitations, attempting to put pressure on companies, publicly traded or otherwise, to sort of get them to capitulate, frankly, to settlement demands for things that are multiple years old. And that's problematic on a number of respects. It's problematic because, frankly, defending those claims are hard, because you have a statute of limitation for a reason. People's memory fade, witnesses go away, documents go away, and that makes sort of the defense of these claims sort of complex. It's also complex in the sense that if you are sort of a public-facing entity, how you deal with claims, even if they're invalid, even if they're ancient, has a big impact on your bottom line. So just a quick refresher for those who aren't as familiar with sexual harassment law in general, just to remind folks, there are two types of sexual harassment claims. There's quid pro quo and hostile work environment. Quid pro quo means this for that. You do this for me, I'll do that for you. You go to bed with me, I'll give you a raise. This for that, right? But implicit in that is it's something that only supervisors engage in with their subordinates. And because of that, it also has strict liability, meaning if you engage in it and if you violate the rules, liability is quick and drastic, and there are no defenses. And I do mean no defenses. You're arguing about amount, but not whether or not you're liable. Hostile work environment is different. Hostile work environment claims don't necessarily have that direct tie, but it's basically the environment that you work in is so severe, so pervasively hostile, that it impacts sort of your day-to-day life in a negative, severe way at employment, such that it, quote, alters the conditions of your work. And in those circumstances, you can be sued both by individuals based on acts of supervisors, but you can also be sued on acts of other coworkers, vendors, patients, people who reside at your centers themselves. Their behavior, to the extent it negatively impacts your employees, can put you at jeopardy. Of course, you have defenses to that. Defenses based on policies and whether or not you knew or should have known of the issues and that the individual did or did not raise it. So you have some added roadblocks that you can throw up to these kind of claims, but it really depends on where the claims come from. So the takeaway, if you're thinking about homework coming out of this, you ought to dust off your sexual harassment policies if you haven't for a while. And one thing I'll point out, they need to have very clear reporting lines about who and how claims get to be raised. And one thing that's important is if you don't have reporting lines that are clear, that you can bypass supervisors when raising complaints and go directly to other individuals. That, per se, invalidates the entire policy. So you need to look at not just whether you have it, but the details of it. You also ought to think about, are there other things you need to update? Do you need to think about updating your EEO policy generally, your dating policy for an organization, whether or not you have a nepotism policy? Those are related issues, but frankly, they're good defensive posture things to think about. The same thing with respect to training. If you haven't done training for managers and employee audiences for a long time, that's another good thing to consider. But frankly, you ought to also just in the back of your mind also think to yourself, when I get these issues, how am I going to respond? And it's important to remember, not everything you do is privileged. To the extent something comes up and you begin investigating and you begin creating documents, that's subject to discovery. But when it's done through and by attorneys or on the advice of counsel for the purpose of seeking legal advice, sometimes those investigations can remain out of the public eye in the event of litigation. So you need to think about when these issues arise, do you engage counsel and when? Likewise, do you let your insurance carrier know and when? Sometimes you may waive rights to coverage for some of these things if you delay letting your insurance carrier know too late into the game that you've gotten these issues. So if it arises, don't just think about what you're going to do, but the timing of it. So, separate from me too, other things that are keeping us up with respect to continuing care centers, well, frankly, there's been ongoing traction for the last really 10 years in the area of who is an independent contractor versus an employee, and are people being paid and treated correctly based on their status. This is something that certainly started heavily under the Obama administration, but frankly, it's just picked up speed with the gig economy. And it's hard. It's hard for lots of reasons. But when you look at the definition of who's an independent contractor versus an employee, it's largely an issue of who is in operational and day-to-day control of an individual worker's actions. I mean, does an individual walk and talk and act like an employee? Are they disciplined like an employee? Are they supervised like an employee? Or do they really act like an independent service provider, like somebody who cuts your lawn? Is it very different? Why does it matter? Well, it impacts a lot of different things. Number one, it impacts the Affordable Care Act and your counts that go into whether or not you're covered by that law. It impacts people's coverage for benefits, everything from 401k to your health insurance, et cetera. It impacts also protections, and protections for the employee with respect to EEO, but also protections for you as an employer with respect to workers' comp if somebody gets injured. And it also affects taxes, among other things. And so that's why people are really interested in it. The DOL, frankly, has had a test for years on this, and I won't bore you with it. Some of you who are on the line who are more tax-focused may be aware of the IRS's 20-factor test. This is really a 6-factor test. It looks at a lot of sort of who is providing the services and in what capacity, who controls those services, and whether that really is an integral part of the employer's business or whether it's really sort of a side part that's more independently controlled by the employee. Interesting thing about the test, there was a lot of chatter about this test, which has been around for years under the Obama administration. The Obama administration issued some guidance back in 2015 that essentially said that even though all these factors should be typically weighted evenly, they were going to focus on a couple of particular areas. And frankly, the area about whether or not this is really an entrepreneurial enterprise on behalf of the employee versus the employer. That they said that was going to be their main focus. That generated, frankly, a lot of chatter in the employer community. A lot of people were unhappy about that focus, did not think that was appropriate. That was actually sort of withdrawn, thankfully, and we were happy about that withdrawal under the new administration. And so we're back to the same test and back to the same weighting, such that no one factor is determinative. But it is important to understand that the label that you simply slap on an individual worker does not control. The fact that you simply call somebody an independent contractor does not make them one. Likewise, the fact that you just simply give them a 1099 versus a W-2 does not make them an independent contractor versus an employee. Ultimately, what controls is how you really treat them and what they do for you. And likewise, even if an employee or worker tells you, I really want to be treated as an independent contractor. Do not treat me as an employee. Pay me as an independent contractor. This is what I want. Ultimately, their wishes do not control the ultimate determination. And it can hook you. They never waive that claim. They never waive that right because it's an independent right with the Department of Labor and with the IRS and with others. And so what are some takeaways, especially in your space? Well, you ought to think about what contractor relationships you have that are sort of off the books, non-employees. Who's providing services to you? Are they simply lawn care and some external IT support and others? Or are they individuals who really do provide core essential services to you on a regular, ongoing basis that you control? If it's the latter, they're probably employees and not independent contractors. This comes up a lot of times when you engage temporary workers through people like Manpower and Adecco and others. To the extent that you've got, quote, temporary workers who have been there for, 6 months or more, they're starting to sound and walk and talk a lot more like employees than temps. And the fact that you engage them through an external vendor does not necessarily simply continue to make them an independent contractor. So a lot of times people will put limits on the time limit that you can engage temporary workers in order to sort of limit that liability. And if you need help with that, we can sort of help you think about forms and policies that go with that. The other thing, frankly, and this is wearing my management hat, you just need to think about how you're treating folks and how it looks. It's one thing to take a risk. It's another thing to wave a flag that you're taking a risk. And so if you're going to treat them as an independent contractor, then, by God, let's make them look like an independent contractor. So give them an independent contractor agreement. Make sure you're paying them with a 1099. Make sure you're not paying them on an hourly basis and more on a project basis. Do some things so optically at least they look a little bit more like independent contractors so that you have more defensible arguments if you ever have an issue that comes up. And again, if you need help with that, obviously we can lend a hand and are happy to do so. The last thing I'll mention before I turn it over to Lauren is the Department of Labor's wage and hour overtime rules. And sort of like the slide shows, the mummy lives. We thought this was dead a couple years ago and when there was much rejoicing, but yet under the new administration it is back. What is back? Well, for those who aren't familiar with it, these things came up under the Obama administration where they tried to change the threshold rule for who gets paid overtime and doesn't. Back in 2016, it was supposed to go into effect. There was a nationwide temporary injunction that turned into a permanent injunction later on, and there was much rejoicing. And then new administration came in and decided to do their own rulemaking. They've had listening sessions in September of 2018, and a brand new proposed rule came out here in March. So what does that do? Well, for those who aren't familiar with it, in order to be exempt from being paid overtime, you've got to do a number of different things. You've got to fall within a couple of different categories. For example, you've got to be an executive or an administrative or professional duties capacity, and there's all sorts of tests that go into that. And separate from those duties tests, which we won't talk about, you have to be A, be paid typically on a salary basis, and B, be paid enough. You've got to be paid above a certain, quote, threshold. And that's what the administration changed, the threshold. Under the last administration, they attempted to raise the exempt salary threshold from $23,660 to $47,476, so that if you were below paying people on an annual basis that amount, They may have been exempt before and not paid overtime, and then bingo in 2016, in November, they might have turned non-exempt. So they raised the threshold, and they also tried to raise the set threshold for highly comped employee tests from 100,000 to 134,004. They also tried to put in place a mechanism where not only would these be set, but it actually would have automatic increases every few years based on a variety of factors tied to the economy and certain statistics. Employers hated that because, frankly, even though you thought you might have your exempt status set, voila, in 2 or 3 years, it may change all over. The only people who loved that, frankly, were payroll vendors. Everybody else hated it. The new administration has come in, and they said, okay, we hate it too, but we think there ought to be a compromise. Instead of increasing the salary threshold to a whopping $47,000, which was almost twice what it was before, they're proposing a mid-level increase from 23,660 to 35,308, which is actually lower than the Obama administration rule. They're proposing a newly highly comp threshold increase from 100,000 to 147,414, which is actually higher than the Obama administration rule. But thankfully, under the current proposed rule, there's no mechanism for automatic increases. You may ask yourself, when is this going to take effect? Who knows? It depends on when the final rule will come out. We're expecting the final rule to somehow come out probably in October or late November of 2019. If I had to guess, it'll be post-election. And then it'll probably have an effective date possibly sometime in January 2020 or thereafter. It depends on, frankly, lobbying efforts on behalf of employers about when that will take effect. But sometime in 2020, you could probably expect to see this take place. So what does that mean for you? You need to budget accordingly. You need to start thinking about this now. A lot of people, frankly, already took action back in 2016, and for those of you who did, this may be a no issue for you. For everybody else, it's going to affect your numbers, it's going to affect your budgets, and you need to think about whether you need to sort of think ahead and reclassify individuals looking forward to 2020. The other thing I'll just mention to you before I turn it over to Lauren is, you ought to also think about this not just as an obligation, but as an opportunity. Frankly, if you are paying people inappropriately, when I mean inappropriately, if you're paying individuals as exempt, when in reality we all know they probably should be non-exempt, changing them midstream is hard because people always wonder, why are you changing me? If you're changing me now to non-exempt, does that mean all the time you've been paying me before I was wrong and you owe me liability for 3 years plus on this, right? And so normally changing itself, how you model that, how you communicate it, can be really touchy. But if you have a change in the rules, it's easy to say, well, the government, they're crazy, they're changing the rules again. You were exempt, but now you're not exempt. Sorry, starting January 2020, this is what's going to happen, right? It gives you some cover so that people sort of don't raise an eyebrow about why you're changing them. So when you're thinking about this test, don't just think about people who fall within and out of it based on the new rules, but also think about, is there anything else that we need to clean up at the same time? And if there is, you can use the regulatory cover as a mechanism to do that, and you can roll it all out in one sort of common denominator. So that's it for me for labor and employment side of the house. We're going to wrap up now talking about healthcare, federal law, and contracting considerations. And I'm going to turn that over to my compatriots. Thank you.
Thanks, Brian. Hi, everyone. As Lisa mentioned, my name is Lauren Ramos, and I am in the healthcare group at McGuire-Woods. However, we tend to broaden our scope a little bit when we do work for continuing care retirement communities, dealing with a broader regulatory scheme under federal law, and also assisting with reviewing actual contracts for residents coming into the facility. We've helped clients kind of revamp their forms and addressing issues that truly are based on real-life issues that have come up. So this last portion of our presentation is going to run the gamut a bit and be a little bit more expansive beyond just healthcare issues. To start out, just an overview of all the different regulatory requirements that you're facing when you do have a facility that runs from, essentially a real estate rental capacity all the way to end-of-life care, potentially, and everything that's in between. So under most state laws, CCRCs are governed by the insurance division of the state. That includes North Carolina. So a lot of times we're actually dealing with insurance requirements for seemingly obvious reasons. In addition, you get into healthcare licensing. So assisted living and nursing facilities are subject to licensure in most states, including North Carolina. So you have to meet all of those requirements with the relevant agency, typically subject to inspections on a routine basis, and things like that just have to be taken into consideration and addressed. And in addition, in North Carolina, as well as Virginia, where I am, has a Certificate of Need program that encompasses nursing home beds. So you cannot just arbitrarily establish a nursing home with nursing beds or increase the number of beds at your discretion. You have to actually go through a state approval process. So we just have a lot of regulatory requirements given the nature of what CCRCs provide. You also have to the extent that you're providing care and want to receive Medicare reimbursement, which typically there is some element of that in a CCRC, you have to comply with the federal regulations. And particularly, the majority of where that reimbursement will come from is providing skilled nursing facility services, or SNFs, as we refer to. And all of these requirements and regulatory schemes that are listed on this slide all have obviously very detailed requirements. They have nuances, they have exceptions that are just beyond the scope of what we have time to address today. But I did want to point out a new change in the SNF reimbursement, which is consistent with the overall efforts by the government, by CMS particularly, to move from volume-based reimbursement to value-based reimbursement. And so reimbursement for SNF services are no longer going to be based on just the volume of the therapy that's provided, but it's actually going to be a rate that is calculated specifically based on the patient. There are a lot of factors that go into this based on the patient's need, the type of therapy services that are provided, how those therapy services are combined. And that is determined at the initial 5-day mark. You submit information, they determine your rate 5 days into a patient's stay that can be considered a SNF stay and is therefore reimbursable. And then that is the rate for the entirety of the patient's SNF designated stay. So it puts a lot of pressure on that determination at the beginning, and it also changes just generally how the reimbursement is going to look for facilities providing that. And since this is one of the few services that are actually reimbursable by Medicare that are provided as CCRC, I wanted to bring your attention to that. Can certainly be impacting revenues that are coming in later down the road, and this goes into effect in October. And so, as I said, we go beyond healthcare laws in our group to address some other federal regulatory issues that impact CCRCs. The biggest ones that we deal with on the federal level, other than Medicare, are the Fair Housing Act and the Americans with Disabilities Act. Both of these prohibit discrimination against persons with quote-unquote disabilities. They have similar definitions of what a disability is. And the Fair Housing Act prohibits discrimination in housing, and the Americans with Disabilities Act prohibits discrimination in public accommodation. And so both of these, you can see how they would apply to CCRCs. A few years ago when we were giving presentations on Fair Housing Act, we would have been talking about whether or not it does apply to CCRCs. There hadn't been concrete evidence that this was going to be enforced against retirement communities. But now, and ways to kind of hedge that and to try to work around it. But now it's pretty established that it does apply. And, of course, the Americans with Disability Act applies to any public accommodations. When you have common areas and accommodations that you're providing to people, it applies there as well. Of course, just due to the age and the stage of life that most CCRC residents are in, they are likely to have conditions that constitute disabilities. So this may be sensory impairment, visual or auditory. It may be mobility issues, lots of things that are just very typical in that population. So it's something that will come up a lot in the CCRC environment. Either residents are exhibiting those conditions when they apply for residency, or it comes up later on during their time at the CCRC when they are needing to be potentially accommodated or transferred up to a higher level of care. Both of these laws require CCRCs to provide reasonable accommodations for disabilities. And again, there are a lot of nuances to what that means and to how that can be restricted or not restricted, but generally it needs to be considered whenever someone requests an accommodation for something that would constitute a disability. It's not something that can be brushed off because we're a CCRC and, you know, we offer what we offer, and that's the end of the line. That is asking for potentially a discrimination claim under one of these laws. And both of these laws are enforced by the Department of Justice. So I wanted to set the stage with these laws, and we'll get into a little bit more about what this means for practical day-to-day issues, starting from marketing, when you are just going out and finding residents and trying to generate business, all the way through the end of a person's stay when you're transferring them between levels. So the FHA specifically addresses marketing. You cannot market in a way that indicates a preference, limitation, or discrimination based on someone's handicap. So you have to be really careful about what that means. Very generic, across the board kind of marketing that doesn't target a specific group. It doesn't say something like, move on to the next slide, it doesn't say something like residents should be active or preference people who aren't in wheelchairs, things like that. Then moving on to when you're actually admitting someone, there are a lot of cases on this, some that actually came out of, at least one that came out of North Carolina, that you cannot technically impose quote-unquote independent living requirements in your admissions or in your transfer decision. So you can't actually inquire as to someone has a handicap, and you can't technically require that they can live in independent living without disabilities that would prevent that. So we don't want to include that. We want to really focus on the healthcare aspects of it, include healthcare personnel, make sure you're tailoring everything and documenting everything in the context of being compliant with insurance requirements, so basing things on actuarial analysis, because you just have to meet your requirements under the insurance laws to maintain financial viability and to be able to meet the needs of the patients that you're offering essentially an insurance product to, and to frame it in the context of sort of ethical concerns and healthcare concerns as to where and how can we actually care for this person. If it's outside the scope of what we can ethically provide to people, then that would be the way you would want to document that if you are denying admissions or if you're forcing a transfer to a higher level of care. And then moving on to, you've admitted some residents and you're going to be asking them to sign a residency agreement. You can't discriminate by including different provisions in leases that apply to someone differently because they have a disability or because they need something that is considered a reasonable accommodation to accommodate their condition. We, like I said, have helped revamp forms for different clients, and we find certain things that come up a lot, one of them being consistency between types of agreements. So some people are entering into a full life care agreement, some people are just entering into a fee-for-service agreement, but you want to make sure they're consistent, make sure they contain all of the state laws, all the provisions that are required by state laws. So most states require certain disclosure statements to be included. States also have requirements on how and when entrance fees can be withheld or must be refunded, and you would want that up front in your residency agreement. And you want them to be really comprehensive. So just addressing every possible scenario that you can think of that might come up and that the resident might challenge you on from the time that they move into their first independent living apartment to the time when they are eventually in the nursing facility. So things like transfer requirements and procedures. When can you force them to do that beyond their voluntary transfer? All of those things that we talked about with the admission decision should apply, being very careful in how you assess someone, how you document it before you force them to transfer. Again, termination options and entrance fee refunds, liability of residents for everything. You want to make sure it's really clear that they understand, that they agree that they are liable for their medical costs that are not included, for their, any incidentals that are not included, what is included, what's not included. And then in the event that you have, and also if they cause any damage or if their guests cause any damage or any liability to the CCRC, you want to make sure that's all covered. And then move out. If you do have the scenario where someone is leaving either voluntarily or involuntarily instead of staying for the duration of their life, how does that look? How much time do they have to vacate? What are your rights with respect to forcing them out, with respect to dealing with the personal property that they may leave behind? How long do they have once you've given them notice? Things like that. And then we'll just quickly talk about reasonable accommodations because, again, these apply to both under the FHA and the ADA. So one of the key things is that it's not reasonable if it would impose an undue financial burden or administrative burden or fundamentally alter the nature of the provider's operation. That's a pretty squishy standard there, so it's always good to think about it, maybe get legal advice when you're considering whether to deny a reason. Having good policies and procedures in effect that address this will help as well. But what is permitted is time, place, and manner restrictions if they're tied to legitimate safety concerns. So we'll just quickly go through. This is one of the most common issues that we see where residents are requesting to use mobility aids, such as segways, scooters, motorized wheelchairs. This is something that's come up with a lot of our clients where they're saying, how do we deal with this when we really can't accommodate all of them, we can't accommodate certain types, etc. So it is certainly expected under the FHA and the ADA that you will permit mobility aids as a reasonable accommodation, but you can put requirements on it if you have legitimate safety concerns about people using them. So here are some factors that you can consider when you're deciding whether to accommodate the specific device. How much pedestrian traffic do you have and when that could cause a safety concern? the design of your facility, safety requirements, and when it legitimately creates a substantial risk of serious harm. You want to base that on the device, not the person. So you can't say, we don't think that you can safely operate this based on a disability that you have. So you have to be careful about that if you're making any denials of use based on the device, not the person. And then the types of time, place, and manner restrictions that you could put on it are such as you can't use it in certain areas during certain times, because that's when we have the most people in that area, and it would be a legitimate safety concern. If you restrict them from certain areas at all times where there's just not room for them to safely maneuver, but it has to be really closely tailored and be the minimum amount of restrictions that you can put on it for the safety of other residents and to not cause damage to the property. So these are just some do's and don'ts that we consider when we're looking at this issue. And again, this is just one type of reasonable accommodation that you may be requested or required to make. Just as an illustrative example of how you would go through that analysis and how you might be able to reasonably accommodate. And then the last thing is just to end on a high note, I guess, discussing end-of-life care. So we've marketed to residents, we've brought them in, we have, gotten a really ironclad residency agreement signed. They've transferred through the levels of care. Hopefully they've lived, a long, happy time at your facility, but eventually they are maybe in the nursing facility, and they require some end-of-life care. So our strong recommendation is to have residents execute a power of attorney and an advance medical directive when they move in. If they already have one, to provide a copy of that to you. And then require, re-ups, say on an annual basis. Have you changed anything in your documents that you haven't given us? Do you need to change? Because then you don't have to guess if it comes down to making end-of-life decisions. If that's not the case, then state law does provide for who the decision makers are if you need to go down that route. And then if you are providing inpatient hospice care for residents that are terminally ill in your facility, there are very strict Medicare requirements and documentation requirements that have to be followed. So that's kind of a big overview. Again, there are just a lot of nuances and details in all of these issues that we'd be happy to discuss with you or answer questions about later on. And then turn it back over to Lisa to wrap us up.
Thank you so much, Lauren. Thank you to everyone for participating and calling in for today's call. We greatly appreciate it. In respecting your time, it's now 1:30, so we are going to answer any questions via email directly to you. Thank you for your questions that are coming in. As you can see, we've got a broad breadth of experience and knowledge in areas that are of acutely important to you, and would be happy to answer any questions that you may have. Thank you and have a good day.